Hello, I'm John Swift, the Chief Investment Officer, and welcome to Benchmark's fourth quarter of 2021 market outlook. In summary, we are moving towards a more cautious outlook on global equities. During September, we are continuing to see risk factors build while equity valuations remain at very high levels. And while global earnings estimates for 2021 have provided a strong tailwind for markets, this growth is now fading as earnings forecasts have begun to slow down, and the index of leading economic indicators is confirming the slower macro conditions underpinning these estimates. We therefore take the opportunity to move to a cautious position on global equities, notwithstanding the still positive current economic conditions. On this more cautious outlook, we believe portfolio managers will face monetary and fiscal headwinds in 2022, in addition to a progressive slowing in economic momentum. Furthermore, inflation in developed markets has been higher than our earlier expectations, and inflation uncertainty in survey data continues to increase. Thus, the combination of a slowdown in growth and inflation remaining higher for longer than the market expects could represent a challenge to equity market progress in the coming months. So we believe it is the rate of change of economic outlook which drives markets. So as momentum slows, there are both qualitative and quantitative arguments that would suggest investors should tactically lean against the prevailing positive market sentiment at this time. There are other factors supporting our caution. One, the central bank monetary support through its $120 billion monthly asset repurchases is ending, which removes the lid on the yield of Treasury and mortgage-backed fixed income securities. Two, consumer confidence readings are becoming much less optimistic. Three, the potential of significant corporate and personal tax increases represents a form of fiscal tightening over the U.S. economy. Four, geopolitical risks between the U.S. and China, and a Taliban-controlled Afghanistan, increasing the specter of increased terrorism around the world. 5, China's regulatory crackdown on the information technology sector and property development woes hamper economic growth in the world's second largest economy. And finally, the debt ceiling fight in the United States. Now, up to this point, all these concerns have been trumped by the actions of the Federal Reserve. They have indicated that the increase in inflation is transitory, their future tapering of asset purchases does not amount to monetary tightening, and an easy money is not going away anytime soon. However, the market reaction to the Federal Reserve Open Market Committee meeting of September 21 and 22 would indicate that the market believes that the interest rate tightening will be pushed out beyond what the dot plot of individual Fed governors' interest rate estimates would show. Otherwise, we should have seen a pullback in valuations to coincide with the Fed's more hawkish tone coming out of that meeting. In short, the market doesn't believe that we can continue economic growth without the longer-term continuation of the Fed's zero interest rate policy beyond their current forecasts for interest rate increases. Put another way, the market does not believe that the current economic growth will last long enough to allow the Fed to raise rates on their forecasted trajectory. So life beyond COVID. The economic recovery from COVID-19 in developed markets has been rapid during 2021, aided by fiscal policy, monetary policy, and the vaccine's quick development and distribution. The continued absence of a COVID variant yet more infectious than Delta and effective vaccines have kept hospital admissions below the critical levels that would trigger social restrictions generally. Furthermore, a significant degree of naturally acquired immunity amongst younger adults offers additional protection from a surge in cases later this year. So there's being a shift in focus from COVID to inflation and interest rates. The critical risk factor to the outlook, in our view, is no longer the evolution of COVID-19, but the evolution of inflation. Implied market-based measures of inflation would appear to show little cause for concern. Still, we'd also argue that pricing is primarily suppressed by investors' focus on central banks' asset purchases in recent years. Consumers, particularly lower-income consumers, believe a significant increase in inflation lies ahead in the coming years. A rise in inflation uncertainty is an unwelcome development as it may create monetary policy making uncertainty and historically has been associated with significantly lower market valuation multiples than prevail today. We therefore take the opportunity to move to a cautious position on global equities, notwithstanding the modest declines over the past few weeks and still positive current economic conditions. We believe tactically shifting allocations to lower risk assets and adding cash allocations to portfolios, emphasizing capital preservation rather than returns, is prudent for the short term, given these slowing economic momentum. Slowing earnings estimates. While global earnings estimates for 2021 have provided a strong tailwind for markets, this impetus is now fading as earnings forecasts have been rising beyond those prevailing before the pandemic. In addition, we note that over the past month, earnings forecasts have stopped growing for most global sectors. In addition, the Manufacturing Purchasing Manager Index, PMI, appears to have peaked over the summer, although they are still at levels that indicate growth in developed markets. We also note that the declines in iron ore pricing and the below 50 manufacturing PMI reading in China signals a contraction is underway. In terms of valuations, the median forward price-to-book multiple is at 15-year highs globally. Corporate credit spreads are also making lows not seen since 2004. What this means to investors is that we're not being compensated adequately in either market for the risk we bear in these investments. Fed meeting, a more hawkish outlook. The Federal Reserve brought a hawkish tone to the September policy announcement and press conference. Chairman Powell and the FOMC have been trying tirelessly to delink the path of rate hikes with the course of asset purchase tapering, implying that the start of one does not impact the timing of the other. Unfortunately, the Fed has failed to convince the market of this timing difference as short-term interest rates rose to reflect the hawkish tilt. During the press conference, Chairman Powell said that conditions were all but met for the Federal Reserve to start tapering the size of asset purchases. However, Chairman Powell added additional color, saying it seemed appropriate to begin the tapering process soon and conclude sometime around the middle of next year. So for example, suppose the Federal Reserve starts the process of tapering in December. In that case, that leaves a roughly 6 to 10 month tapering window for the Federal Reserve to scale down asset purchases for the $120 billion per month. The slowdown in leading economic indicators. Leading economic indicators suggest the cyclical slowdown in business cycle is beginning to occur and is likely to persist for the coming months. Credit formation measures the rate of change of new credit as a percentage of GDP. Unlike pure monetary measures such as M2 money supply, credit creation measures the rate of credit change in the real economy via commercial bank lending and fiscal deficit spending. It thus acts as a far better tool for predicting real economic growth. Credit creation is effectively a leading indicator for just about everything, usually by about 10 to 12 months. Also confirming the deceleration in growth is the manufacturing sector. The U.S. Census Bureau manufacturing inventory to sales ratio continues to trend upwards to nearly positive on a year-over-year rate of change. So when sales are rising faster than inventories and the ratio falls, more inventory needs to be produced, thus adding to economic growth and an increased need for workers and hours worked. That's a good thing. Conversely, when inventories rise faster than sales, the inverse occurs, as is occurring today. We can extrapolate this further by focusing on the Census Bureau's data on new manufacturing orders, which continues to decelerate after peaking in April of this year. As new orders are very demand sensitive, a deceleration in the data indicates a slowing growth in the manufacturing sector. Finally, from a consumer demand perspective, the University of Michigan's Consumer Buying Intentions Survey for vehicles, houses, and household goods all remain near the lowest levels in some time. In addition, the spike in inflation over the past number of months is impacting consumer demand for goods. As a result, demand is not only waning in the manufacturing and construction sectors, but at the household level too. So as always, we look forward to catching up with each of you, and we will be reaching out to schedule a time to meet in person or through a virtual call. If you'd like to get something on the calendar in the interim, please send me a note with some dates and times. I look forward to seeing all of you, and thanks again for spending some time with us today.